talk about rules for creating a compensation strategy that drives growth. Slides coming up here in 1 second. Okay, let's dive right in. I love this subject. Compensation is sometimes an underappreciated, underutilized, undermanaged part of an organization's overall operational responsibilities. And sometimes it's taken for granted. So we're going to explore this question. I'd like you to come up with a number in your mind. What is your company's total rewards investment? That's the sum of all expenditures on salaries, wages, bonuses, commissions, long-term plans, retirement plans, benefits, payroll taxes. Come up with a number in your mind. That number could be a couple $1 million, 20 million, 200 million, doesn't matter. But let's just get that number in your mind. Now, this is probably, if you're like most companies, the largest expense on your P&L. So now, if it's an investment, note the term total rewards investment, you should be getting a return on your investment, right? So what is that return? Can you come up with a number there, a percentage return? If that number was being invested, you had that number at Fidelity, Vanguard, Schwab somewhere, you'd be tracking its performance, wouldn't you? But let me ask you if you're tracking the performance on your total rewards investment. How do you measure it? How is it trending? Who's accountable for it? How can you improve it? And what might be the most significant factor that's suppressing that return, no matter how good it is? There could be a number of things that come to your mind in answer to that question. But obviously, we're going to talk about compensation as a major factor affecting that return. So we have a term we call compensation chaos. When an organization lacks a coherent compensation strategy tied to their business plan, when they lack accountable decision-making, where decisions are being made in various parts of the organization on kind of a almost random or ad hoc basis, and when that organization lacks internal or external expertise, resources, and time, what's going to happen? Well, we're going to see that employees ultimately do not really understand or appreciate their full compensation opportunity. And there's plenty of studies that show that this leads to low engagement, poor retention, or at least not optimized retention. And therefore, the shareholders are going to feel, even if they're not measuring it, that they're getting a low or negative return on their compensation spend or their compensation investment. So let's explore 5 keys to creating a compensation strategy that turns that around, that turns compensation into a driver of results in your organization. First, you have to define value creation. You have to have a clear compensation philosophy. You have to transition from incentives to value sharing. That's more than just semantics. We'll describe that. Then you adopt a balanced pay strategy, and then you communicate growth partnership. We won't have time to go deep into each of these subjects, but I hope to give you enough to get your imagination going about the impact on your organization if you achieve these results. So first, you define value creation. Now, a lot of different ways organizations might try to do that, but what I'm going to do is suggest that you might want to consider a measure like productivity profit. That's kind of our favorite measurement. There are other things you can do in revenue per employee, profit per employee. Let's talk about this one. It's a fun concept a lot of people like to learn about. So let's look on your balance sheet. On your balance sheet, you're going to see something probably called shareholder equity. Shareholder equity is also essentially equivalent to a company's capital account. I'm going to use capital account here because think of it as it's the capital your shareholders currently have invested in your company. In this example, it's $20 million. Now, if they were investing that somewhere else, which I guess they theoretically could, they'd be expecting some kind of return. We'll call that the cost of capital. Let's imagine they're expecting 12%. This 12% times that 20 million gives us $2.4 million. Let's call that a capital charge. I don't want to get too fancy with all the accounting terminology, but essentially that's the return the shareholders might be expecting annually on their capital account. Now, there are two primary things at work inside an organization. You have capital and you have people. Now, there's other stuff too, but let's think of those as the primary generator of revenue and profits. If this company's operating income was $10 million, we've got to account for that 7.6. In other words, 2.4 million is coming from the capital investment. That 7.6 must be coming from where? Well, it's your people. It's your employees are generating that by executing on the business plan. We call that productivity profit. It's a positive number, so it's demonstrating that we are getting a positive return on our TRI, our total rewards investment, which in this case is $25 million. Let's divide the one into the other. We've got a simple ratio arriving at 30.4%. That's what we call ROTRI, the return on your total rewards investment. And it's out of that productivity profit that the shareholders justify paying out variable pay programs. We call it value sharing, incentive programs that are recognizing the contributions that the employees have made in the organization. That's productivity profit, and one way of measuring value creation. Now, you also need a clear compensation philosophy. What's that? It's a written statement that's been vetted and analyzed and constructed and shared with employees that says, this is what we pay for. This is how we define value creation. This is how we try and meet market standards. Are we above or below? How do we share value in variable pay components? It's a 1.5-page foundational document of the company's directional pay strategy. And it can be concrete in what we're doing now. It can have aspirational elements, but it really helps employees understand your pay approach. Imagine hiring a new employee, and before you make the pay offer, you say, here, read this. This is our philosophy of pay. That can curtail or eliminate problems down the road when the employee comes back and says, how come we're doing this? Why is my pay like that? You can start by saying, do you remember our compensation philosophy statement? Let's review it and see if we're being consistent in our practice of it. Compensation philosophy statement defines how value creation is expressed, how it's shared, what market pay standards apply, how do we balance guaranteed pay and variable pay, and how do we balance short-term commitments and long-term pay opportunities, how is merit pay managed, and a number of other things. Okay, now the third premise or the third concept is we want to, if possible, flush the term incentives or even bonus from our vocabulary. If we think in terms of value sharing, you can see how we're connecting to productivity profit or whatever measurement you use in your organization to confirm with the shareholders that you're producing positive results. This justifies value sharing. Sharing with employees some of the value they help create. Stephen R. Covey, the late great organizational behavior consultant, he said you can't hold people responsible for results if you supervise their methods. So we've transformed that to you can't hold people responsible for results if you pay them for their methods. You pay people for results, not their methods. So the concept of value sharing is simple. Hey, here's how we create value in our organization and how you participate in that value. Because if you help us create value, you deserve some of it. And we have so our incentive plan, our value sharing plan is the structured way we define how we share value with our important team members, our growth partners. So just the premise alone shifts the thinking in an organization as we talk about how we value our employees for creating value for our customers and our shareholders. And we recognize that we're in this virtual cycle of creating value and sharing value and making it meaningful and not just transactional. So ideally, you're rewarding something like productivity profit or some other vital, essential, top of the list priority for this financial stakeholders in the business. Remember, productivity profit is the surplus that's attributable to the contributions of the people, not just the contributions of capital. Again, there are different ways you can measure this. It's got to be unique to your organization and fit your financial standards, your strategic goals, your business model. So it takes some conversation to arrive at the right and ideal standard for creating value sharing arrangements. And I'd also say this, productivity profit is best viewed as a baseline at first. You track its trend line over time. So sometimes you have a negative productivity profit because you're investing so heavily in growth. And the shareholders recognize that. Once employees learn that, they can respect that. But then you establish some other benchmark that you measure in order to justify or create the baseline markers for sharing value in the organization. So you can invest in value sharing even when productivity profit is low or even negative. Now, that gives you then a standard so that over time, the shareholders can feel like you're being accountable stewards of the investment in pay in their team because they're seeing improvement in productivity profit or improvement in their ROTRE, the return on their total rewards investment. Okay, let's look at this concept. Adopt a balanced pay strategy. A pay strategy needs to reflect a number of moving pieces within an organization and try and capture within a limited budget the different elements of performance the organization is stressing and striving for, different outcomes that we're reaching for. So let's look at this simple chart of 8 components of leadership pay. That should say leadership pay up there. On the right, we see the stuff that typically shows up in the W-2 sooner or later, plus equity there. This is what a person might say when they are asked the question, tell me about your pay program. Well, I get a salary of X. I get a bonus plan, an incentive plan, or a value sharing plan target of Y. And I get some long-term incentives, cash-based of Z. And if they have equity in the company, that might come up. Or if the company is awarding equity, then that would be a component of what we'll call the compensation side of the total rewards investment. Now, most of our clients are private companies. We discourage awarding equity, but we shore up the long-term incentives to do that. I think Ken's going to talk later about the different types of long-term incentives that become essential, really crucial in this conversation. On the left side is the benefit side of the total rewards formula. Your core benefits, your health and welfare plans. Now, sometimes some companies enhance those benefits for the leadership team because there are certain things that the core benefits are restricted in providing by statute, limitations on certain arrangements. Same thing happens when you move into qualified retirement, like your 401k, profit sharing, pension, ESOP. Sometimes some companies supplement the leadership team there too with deferred compensation or similar arrangements. So these are the 8 most common components, and there are other things we could add in a more comprehensive discussion someday. But the question then becomes, well, how do you choose from this list? Which do you emphasize? Should you emphasize above market salaries and lower than market incentives, or vice versa? Should you really appeal to kind of the benefits position and to provide the message to the people you're attracting to your organization that we're taking care of you on kind of a committed side of salaries and benefits? Or do you have a more entrepreneurial organization where you're saying, hey, our salaries are a little below market, but guess what? Our total pay package is way above if you perform, and you're telling me you're a performer. So if we add your performance into the equation, we're going to share much more here than you might get anywhere else. So that's what we're talking about, starting with your pay philosophy that's then captured in your pay allocation. Let's look at an example. So on the left, you can see here an organization. It doesn't matter what the dollar size is here, but you can imagine this is the pay totals for your leadership team. Let's think in terms of however you want to quantify in your leadership organization. What we see here is, if you look at the colors, a lot of blue, heavy emphasis on salaries. We call that, in the bottom left, a short-term fixed commitment, and pretty attractive short-term incentives. So now we're still in the short-term box at the bottom left, but it's at risk. As we move to the right, we look at long-term compensation. There's about 6% that's fixed. That's the retirement, qualified retirement plan, but there's nothing at risk. This would be a tough offer package to an entrepreneurial go-getter employee who you really want to help grow the organization. So this company probably needs to restructure their investment in pay. And you can see now what we've done is we've reduced the blue. The red is about the same, but we've added a green component. That's long-term incentive. So look at the bottom boxes now. Our short-term compensation fixed commitment has gone down. The at-risk short terms dropped slightly, but what we've done is we've now beefed up the long-term commitment by adding a long-term incentive plan and looks like a little bit of deferred compensation for retirement. That's a fixed long-term. Get the idea? Now compare this to that investment concept. Imagine you took the total pay of your leadership team. Let's say it was $3 million. And you went to an investment advisor and you said, hey, invest this money for me. How would you invest it? They're going to ask a lot of questions. They're going to ask, well, what are your objectives? What's your risk tolerance? What's your time frame, and more? And then they're going to come back to you with a portfolio, right, of recommendations. And many of you perhaps have done this on your own or with an investment advisor. And that's kind of what we're doing here. We are trying to create the allocation of pay components, which will generate the performance that will produce the highest possible productivity profit for your organization. That's how these pieces link together. That green piece responds to this. Some of you may remember Peter Drucker, if you're in my demographic, brilliant management consultant. He said, the manager's job is to keep his nose to the grindstone while lifting his eyes to the hills. He meant every business has to operate in two modes at the same time, producing results today and preparing for tomorrow. This again is what Ken's going to share with you later in this morning. Great concepts on how to accomplish that. Now, that little graph I showed you, it's not a commercial because this is a free giveaway. If you want to do that for your own company, you can go to pro.visionlink.co. That's not our main marketing site. This is a different site. But if you go there, you'll see what's called, beneath the login page, you don't need to log in, an executive comp assessor. It's complimentary, confidential. We don't even have access to it. You can do it on your own. When you follow 3 steps, you're going to plug in some numbers on your leadership team pay. And you don't have to put names in or anything. You can make up the numbers if you want. Then you answer 10 questions. And then it's going to produce that little chart I showed you. And beneath the chart, there's an explanation of the logic behind it. So you're welcome to use that tool for you if you find this intriguing. And of course, if you want to talk about it, just let us know. Okay, last piece, communication. You know how in real estate, they say everything's location, location, location. In compensation, it's communication, communication, communication. Most companies fail at communicating their compensation strategy, opportunity, and details to their employees. There's limited information. Some do maybe a total reward statement at the end of the year. Most don't even do that. I was looking at a recent survey of large companies and how they communicate, and most of them acknowledge they do a bad job. But if you can't get the opportunity, the future opportunity of the pay arrangement into an employee's heart and mind, you're not going to change behavior. Behavior changes with intrinsic commitment by an employee. And when they feel like they're being treated like a partner in the organization, that's when that begins to change. So what we communicate to employees is, here's our future as an organization. Here's where we're going. Here's how we're going to get there. Here's how you can contribute. So the first one is our vision. The second one is our strategy. The third one is you. Here's how we see you contributing. Let's talk about that. We want you to identify ways you can contribute to the fulfillment, the execution of that strategy, and the creation of that future. And if so, here's what it means to you. So the compensation program that's presented to an employee should be future looking, not just historical. It's fine to say, here's the hidden paycheck. You didn't just make $90,000 last year. Our full commitment to you was $126,589. But going forward, if you can present that, that changes the whole story. This is what's called an employee value statement, what we've budgeted for you in our growth plan. So now imagine you're recruiting this, attractive employee, and you're offering a $160,000 salary and a really attractive short-term value sharing opportunity. And now they go down the street to your competitor, they're talking to them too. It's basically, here's your salary, here's your bonus, here's your benefits, and that's what you're competing on. But if you can say to the employee, I've shared with you our business plan and goals, and you've acknowledged that you feel like you can contribute to the achievement of those goals and those results. Here's what we intend to pay you. It's going to change because those results won't be exactly that. You might get promoted. We might change some of these plans. This is not locked in stone, but the way we view it now, we've budgeted about $1.8 million for you over the next 5 years, plus benefits. So the employee value statement, I think, is more appropriate for today's employee. It's not just what are you doing for me now, it's what does it mean for me to contribute? Today's employees are looking for much more than just pay, but if you can entice them with a pay commitment that's more meaningful over time, you have a leg up in recruiting and in retention, because implicit in here is also forfeitures. There's walk away money in a long-term value sharing plan that the employee forfeits if they leave too soon. It really rounds out the pay package in a more robust, meaningful, and compelling way so that employees feel like they belong. They're being treated like partners in the business. Your commitment to them is sincere. And they also understand they have to create value for the shareholders before they should expect to earn meaningful value for themselves. Okay, let's wrap up. We'll take questions in a minute. Love to type questions into the little Q&A panel. I think it's over on the right side. Looks like we've got some coming in there. We'll have about 7 minutes for some questions before our next speaker. But let's just review. Define value creation for your organization. Don't base it on what your competitor does or your cousin's business or something outside your industry. You know your business. Define value creation as it means something to your owners. Then build a pay philosophy that says, in order to create that value, this is how we intend to pay people to reward them for the creation of that value. Then take your mindset. You can still use the word incentives or bonuses or whatever you want, but the mindset is value sharing. We've told you, employees, how we create value. We've showed you how we're going to share that value. So it sounds like value sharing is a better term. It's not just semantic. It changes the way of thinking about the variable pay program. Then you've got to study the balance of pay. Are we overpaying on fixed, overpaying on variable, short-term, long-term? It sometimes takes time to make that transition. If you discover that, hey, maybe we're overpaying on the fixed side, we want a little more entrepreneurial bent, it's hard to just go to employees and say, hey, we got this new philosophy and we're just cutting your salaries and giving you more upside. There are transitions that are necessary, obviously, in that time. but that's something you can aim for. And it's pretty easy to develop the track to make that happen if you're committed to it. Then, jumped ahead. Then communicate that we view you as partners in our business. You may not have formal equity, but you have a stake not only in sharing in the value we create this year, but in the value we create going forward. So I hope these 5 ideas will be helpful to you. I'd love to hear more about your thoughts and questions in the chat or in your questions. And also, obviously, we're available anytime for contact. So we're going to take some Q&A here, but do remember to respond to a little poll is going to pop up, I think, now or shortly. And we'd love some quick feedback from you as well. Ken, ready? Do you have any questions for us?
We do, and great stuff, Tom. And just to reiterate what Tom just said, the poll question can be found if you look for the little 3-bar icon under the Q&A icon. Click on that, you'll see the poll. It's just 2 questions. We appreciate it if you just respond. It just gives us helpful feedback for the session. One is basically rating the session, how you felt it went, and the other is just whether or not you'd like to hear from VisionLink. So the first question, Tom, comes from Nora, who said, this is back to the pie allocations that you were showing, that one slide. Okay. She says, do the 2 pies represent the same sum of comp, or is the second pie, does the second pie have more comp, as in dollars, associated with it, and therefore the slices of the pie are different?
Okay, I think I understand that question. So yeah, if this this company was actually migrating to the picture on the right, it may imply a bigger budget for compensation, because this might reflect an organization that's saying, we are investing in our leadership team's future wealth opportunity. And so if they were to move on day 1 from the left to the right, it would imply they're either cutting salaries or they are raising the total commitment. It could be either, or it could be in between. I briefly mentioned it usually takes a transition to get there. But let's remember this. If it is bigger, and for many companies, they do raise it because that means they're raising the variable component. That variable component, which I think you're going to talk about some of those ideas, Ken, are self-financing. They only generate cash commitment to the employee in the event of measurable growth. So you're financing that green piece out of the future growth of the organization. So it's a little bit of a complicated answer. It doesn't necessarily mean there's a current increase in the dollars, but it does imply that we're banking on the team to grow the company beyond a certain level. And out of that growth, we're going to spend more on our employees. So that green section will harvest meaningful dollars for the employees, the leadership team. And for overtime, it's a bigger pie, but it might be a lower percentage of profitability. Does that make sense? It's a lower percentage of overall outlay compared to profit, even though the dollar value is increasing. Kind of a subtle thing you got to get. It takes some conversation, exploration about it, but it's a very healthy and important, if not vital, part of the discussion about how to build a strategic pay offering.
If you want to dive into that a little deeper, if you go to our website, visionlink.co, under resources, you'll find a thing called guides. We have a guide that is talks about something called productivity profit, and the subtitle is basically how to create an incentive plan that pays for itself. And it goes into more detail about what Tom just said and how all your variable pay should be paid out of what we call productivity profit. The profit you can attribute to the contributions of your people, the value creation of people. But that's a resource you can go to get more information on that. Just one quick housekeeping question that's come up a couple of times. People are asking, can I get slides? I mentioned at the beginning, at the end, I'm going to give you a QR code that's going to take you to a landing page that has a lot of free resources. One of those is the slides. So yes, you can get the slides, and that's how you'll get those. Next question. what type of long-term plan works best for a small company?
Okay, so I don't want to steal your thunder, Ken, because I know you're going to go into this in more detail. Ken's going to show you multiple different types of plans, depending on what you mean by small. There's a scale of smallness out there, right? Generally speaking, the simplest type of plan, if that's what's implied in the question, is what we call a profit pool or account balance plan. This is merely a company setting aside kind of some profits for companies that's paid out in the future. Phantom stock plans are also popular. It's probably our hottest selling product on the consulting side and in our software tools. Phantom stock, I'm suspecting Ken's going to tell you more about that. It looks like stock, but it's not. It doesn't dilute the equity of the owners. It's a very growing plan. I think someday it's going to become almost ubiquitous in the small business world because they're getting simpler and simpler, and it's a very powerful way to offer a long-term incentive that looks like, feels like, tastes like, and performs like equity. So those are probably the two most popular types of plans, and Ken's going to lay out some other ones, and he might have a different opinion. So you'll stay tuned to see where that goes today.
Yeah, we'll be talking about 6 different alternatives to sharing stock. If you want a long-term incentive plan, but you don't want to share stock, Tom just mentioned a couple of them, and we'll talk about more. Probably time for one last question, Tom. If you could just describe in a little bit more detail what is meant by a compensation philosophy statement. Maybe
Okay.
Who gets involved with creating that?
Good question. So a comp philosophy statement, it's going to wind up as a 1 to 2 page actual document. I was trying to get on the screen, but that's okay. So what happens is you pull the leadership team together. It might be a few people. You should probably have an ownership representative in this discussion. And it begins with the conversation of how do we draft our compensation philosophy statement? And it starts first with, what is our compensation philosophy? People might think that's a loaded question, but as you start discussing it, it starts bringing things to the surface. Well, I think we believe this. I sometimes say that the compensation philosophy statement is kind of your Declaration of Independence. Then your pay structure is your Constitution. So here's what we believe. Here's why King George is a tyrant. Well, probably don't say that, but you say something about what we believe about pay and why we want to pay our employees, how we want to pay them. Actually do have, I don't think it's in our offering today, but if somebody can connect with me, I can send you a little piece we have about how to build a compensation philosophy statement. It has kind of the step-by-step process. But it's going to tell you, this is what we believe about pay. And it is something that you can share with employees where they can read it, discuss it with you. And then ultimately, you kind of have to live by the standards you express within the comp philosophy statement. So it's an expression of our best practice standards and beliefs about pay. Very, very valuable thing to share with team members. And the decision makers in the company about pay are kind of bound by it. They become protectors of the comp philosophy statement.